Good afternoon. Welcome to my seminar. I'm so glad you wanted to attend. Today, we'll be covering what is momentum, the history of momentum, why does momentum work, what are the issues associated with momentum, and how you can use momentum to earn higher returns with less risk. So let's start with what is momentum. Now, I'm sure you're all familiar with Isaac Newton. His first law was a body in motion tends to stay in motion. Now, this does not apply just to the physical universe. It applies to everything, including the financial world. So what this means is that assets that are strong continue to be strong. So what does this tell us that we should be doing? Buy strong stuff. And let's take a look at what Newton did with this idea of his. Back in the 1700s, everyone was buying South Sea stock. If you had any money, that's where you put it. So Newton took some of his savings and invested in 1720. He very quickly doubled his money and was a happy camper. However, as he was sitting on his assets, watching his friends grow rich beyond the dreams of avarice, he thought, well, I better get back in. So he jumped in with all of his money here. Everything went well for a while until it didn't. As the South Sea stock started to fall, Newton thought, it's going to come back. Then he hoped it would come back. Then he prayed it would come back. And finally he said, it's never coming back. And he sold it all. He lost the equivalent of $3 million, his entire fortune. Now does anyone know what Newton's third law of motion is? For every action, there is an equal and opposite reaction. Where do you think he got that idea? Now it took a classical economist to come up with a way to alleviate this problem. This was David Ricardo, who said, cut your losses short, let your profits run on. Now Ricardo put this idea in practice with his own investing. He retired at the age of 42, having amassed the equivalent of $65 million in today's terms. Other well-known speculators use the same principle. Jesse Livermore said, buy stocks making new highs. H.M. Gartley, in his 1935 book, Profits in the Stock Market, came up with velocity ratings. Velocity, momentum, same thing. George Siemens had a best-selling book in 1939. He said, buy stocks during an advance. And Richard Wyckoff said, buy the strongest stocks in the strongest industries, in the strongest index, when the trend is up. Wyckoff put these ideas in practice. He was able to buy an estate in the Hamptons, right next to Alfred P. Sloan's, who was the first chairman of General Motors. Now this is all good, this type of momentum investing, where we get into something that's strong and we somehow figure out how to get out. But what we really want is a more scientific, rules-based way, something that you and I can go and apply ourselves. And in order to have that, we have to have some research done, where people go through and they test momentum, and they replicate it, and they develop these rules. And this was actually done back in 1937 by two prominent economists, Cowles and Jones. They published their findings in 1937 in a journal called Econometrica. They used every stock on the New York Stock Exchange from 1920 through 1935, and they looked at the performance over that 15-year period. And here's what they discovered. The tendency is very pronounced for stocks that have exceeded the median in one year to exceed it also in the following year. This means stocks that have been strong last year tend to remain strong this year. This is a very important finding. This forms the basis for modern day momentum. This was such an important discovery that guess what happened in the world of momentum research over the next 50 years? That's right, nothing. Not a thing. Why? Well, practitioners weren't even going to get near a journal called Econometrica. They didn't even like the name of it. And academics all wanted to be physicists. So they said, well, stocks generally drift higher, but they just fluctuate randomly otherwise, like bits of pollen jiggling around in water. This became known as the random walk hypothesis. And that later evolved into the efficient market hypothesis. Now, the efficient market hypothesis says that because people are rational, if there were any abnormal profits to be had, investors would take advantage of it very quickly. They would disappear. So you might as well just buy the market. There's no way to beat it. The efficient market hypothesis took over the world of finance for the next 30 years. Now, there were practitioners who continued to make money using momentum. Nick Darvis wrote a book, How I Made $2 Million in the Stock Market, using momentum principles. Jack Dreyfus, founder of the Dreyfus Fund, called the Lion of Wall Street, he said that he only bought stocks that were making highs for the year. Richard Driehaus managed $10 billion using relative strength momentum, just like we've been talking about. He retired to become a great philanthropist. Now, why was momentum finally accepted? Well, in the 1970s, two psychologists came out with some papers. This was Tversky and Kahneman, in which they showed that people consistently behave in an irrational manner. And this is all people, not just my ex-wife. They published a book in 1979 called Prospect Theory. And this attracted the attention of financial economists. The next development was in 1982. Two of the fathers of efficient market theory, Fama and French, published a paper showing that you could make money above the market by buying cheap stocks, value, and buying small cap stocks. So this opened the door for people to think about doing something other than just buying the market itself. And finally, in the late 1980s, there was research done showing that stocks mean revert over a long time horizon. Now what this means is that stocks that have been strong over the preceding 3 to 5 years tend to be weak after that. And conversely, stocks that have been very weak over the preceding 3 to 5 years tend to outperform following that. Now momentum is the opposite, but it's on a shorter time frame. So this opened the door for further momentum research. The seminal study on momentum was done in 1993 by Jagadish and Titman, using US stock market data from 1962 through 1989. They took stocks that had performed best over the preceding 3 to 12 months, and they demonstrated beyond any doubt that those stocks continued to outperform over the following 3 to 12 months. Now, the fact that they did well is good, but the question then is how well did those stocks outperform that were selected on the basis of momentum? So I took the time frame and extended it all the way back to 1927 and up through the year 2014. I picked the top 30% of momentum stocks based on performance over the last 2 to 12 months. We skipped the very last month because that tends to be mean reverting. If we take the top 30% of those stocks that are in a large universe, we find that the annual return is 15.7%. We compare that to the US large cap universe itself, 11.5%, we see an incredible increase in the rate of return. That's 4% more per year. This really attracted the attention of financial researchers. Now the risks remain high. We look at the standard deviation, it's actually a little higher. And the worst drawdown, which is what happens from peak to valley when you're invested, was incredibly high. Still remained that way with momentum. So there was an abundance of research after that because everyone was excited about momentum now. So people looked at momentum and tried to apply it to everything they could think of. And what they discovered was that momentum works well, not just with stocks, but with stock indices, with sectors, with bonds, commodities, currencies, pretty much everything, from the year 1800 right up to the very present. Now the fact that something works well is good. But you really want to know why it works well, to make sure that it's not a spurious correlation. So there are some explanations of why momentum works and should continue to work. The first is that when information comes out, there's an initial underreaction. This is caused by anchoring or conservatism. In other words, people don't want to do anything when information first comes to their attention. Next, there's a slow diffusion of information. It doesn't get spread around to everyone right away. And third, there's what's called the disposition effect. This is an interesting phenomenon that researchers found whereby people tend to want to sell their winners too soon and hold on to their losers too long. Following the initial underreaction to information, we have an overreaction, where stocks or whatever asset it is want to catch up. And this is caused first by herding. When you see something happening, you want to get on board because everybody else is doing it. Herding is built into our DNA. It's what allows animals to survive out in the wild. Then we have representativeness. This is when we see something happening in the short run, we project it in our minds to keep happening. So if we see stocks going up, we think they're going to continue going up. This gives us confidence. But it can also give us overconfidence, where we get over-enthusiastic. And this causes price trends to extend beyond where they should. So here's what happens. Momentum earns very high returns. It works with all assets. There are explanations for it. And academics now readily accept it. Fama and French, the two fathers of efficient markets I mentioned earlier, has said the premier market anomaly is momentum. Stocks with low returns over the past year tend to have low returns for the next few months, and stocks with high past returns tend to have high future returns. Got ahead of me. Oh, sorry. I got to nod my head, not just look at it. Okay. So forget what you just saw. And knowing what we know about momentum now, about stock momentum, how many of you think this is something pretty good, something you'd like to go and invest in? Pretty much everyone. Okay. There are issues. The first issue having to do with momentum is low scalability. Well, what do I mean by that? Well, here's a table that shows compound annual growth rates based on the number of momentum stocks selected out of a universe of 1,000. This is from 1927 up to the present. So we see if we're very selective and pick only 50 stocks, we could be making 18% a year if we rebalance each month. If we loosen things up and go to 100 stocks, it drops to 16.3%, and so on. When we get down to up to 500 stocks, we drop from 18 down to 12.5%. Now, working down the holding period, if we're reevaluating each month, we get a very high return. If we wait for 2 months, it drops. It drops a whole percentage point, and so on, depending on how long we hold before we rebalance. So where we'd really like to be is up in this area, where we hold a very concentrated portfolio and we rebalance frequently. But let me ask you this. What do you think is going to happen if hundreds of billions of dollars all come in and want to trade in the same 50 or 100 stocks every month or two? And this information is readily available. It's on websites. Anyone can find out with the top 50 or 100 momentum stocks. It's not going to be a pretty sight. The next issue is high volatility. I've redone this table and started in 1934 because 1929 gave very extreme values that were not representative of what's happening now. This is more representative. The US large cap universe, standard deviation 15%, large momentum portfolio, standard deviation 17%. The maximum drawdown, 50%. This has happened a number of times since then. The large momentum portfolio, about the same, even worse. Now, what's wrong with high volatility? Well, it makes us do stupid things. Think back to Newton. Buy high, sell low. The Dalbar report comes out every year. It studies the annualized returns of stock market investors over the preceding 20 years. The average US equity fund investor over the past 20 years has made 5% on his money. The S&P 500 index over that time has earned 9.2% per year. This is 45% less than this. That's an incredible difference. And why is that? Yes? The main reason is people get caught up in their emotions. Stocks go down, they become fearful and they sell. Stocks go up a lot, they want to be part of the herd and they buy. They buy near the high and sell near the low. Greg Fisher has said, we don't have people with investment problems. We have investments with people problems. The enemy is indeed us. But we haven't gotten to the worst problem yet. This would be high frictional costs. Here's a study done showing what happens with a large cap portfolio and how much incremental excess return we get if we have a momentum portfolio that rebalances monthly. Before transaction costs, we make almost 3% more than the market. Because momentum is a very high turnover strategy, and because momentum stocks tend to have wide bid-ask spreads, look at the difference here. After transaction costs, we're at a 3% disadvantage to the market instead of an advantage. And many momentum funds do. Our initial advantage drops to 2%. And after transaction costs, we're still at a disadvantage to the market of almost 2%. So let's see how this works out in practice. I've gotten a hold of the largest and oldest momentum funds, so we can take a look at it. This is the largest one. It's the PowerShares DWA Technical Leaders ETF. It began in 2007. It's represented by the red line here. It has $1.8 billion in assets. It's a concentrated fund. It's doing that part right. It only has 100 stocks in it. However, its expense ratio per year is 0.63%. And its index, benchmark index, is the Russell Mid-Cap Growth, which also has an ETF associated with it, which has an expense ratio of only 0.2% per year. Which would you rather have? The fund represented by the blue or the red? Okay. This is the mutual fund. that goes back to 2009. It has $1 billion in it. It's managed by AQR. Now, although this fund only has $1 billion in it, AQR is a giant company, and they manage hedge funds and multi-factor funds, so they have a ton of money in momentum. And so they can't have just 100 stocks in their fund. They have 446 out of a possible universe of 1,000. They're represented again by the red line. And their index benchmark is the Russell 1000 growth. The ETF for that is the blue line. Which would you rather be in? Okay. So now that we've seen what the issues are, and we've seen what the performance has been, as the way momentum is generally practiced, how many of you would still like to invest this way? Well, if you do, I have a bridge I'd like to sell you. It's a nice bridge. So what do we do about this? Well, if we're young, we could just buy an index fund and hold, assuming that we don't do something stupid, which is buy and sell at the wrong time, which most people do. A lot of us aren't so young, and we need something that's going to give us a good return without subjecting us to a lot of risk. So I knew from my studies that momentum works. It works on everything. So I tried to figure out a different way to use momentum. And as I was thinking about it, I remembered a chart in a book that I'd read called Stocks for the Long Run. Now this shows asset class returns from the year 1800. These are excess returns above the risk-free rate. The best place to be would be in common stock. It returns 6.6% per year above the risk-free rate. Bonds were a distant second at 3.6%. Look at how much a $1 grew to with stocks versus what it grew to with bonds. So I knew that I wanted to use momentum with stocks and with stock indices, so I wouldn't have the problem of high transaction costs and scalability. So then I had to decide which stock indices to use. Now here's a chart of world stock returns over time. And we see the very best performer has been the US stock market. US stocks have outperformed the rest of the world by an average of 2% a year. So I wanted to anchor my momentum strategy in the US stock indices, something like the S&P 500. Now, in order to do momentum, you have to have more than one asset because you're comparing one thing to another and going with whichever is stronger. So we're going to deal just in common stock. And if US stocks are going to be part of it, what do you think the other part of it might be? Non-US stocks, correct. So here's what I came up with. Let's switch between the S&P 500 index and the MSCI All Country World Index ex-US, that means the rest of the world. And we'll use a 12-month or 1-year look back, and we'll reevaluate on a monthly basis. So whichever has been stronger during the past year, that's where we'll be invested. Let's see how that does. This is the S&P 500 index. This is the rest of the world index. And this is relative strength momentum. It earns, on average, 3% a year more than what these indexes provide. It takes care of two of our problems. We don't have to worry about transaction costs. There's less than one trade a year switching between these indices. We don't have to worry about scalability because you can invest as much as you want in these two indices. But we do still have volatility. So how do most people handle volatility of the stock market? What do they do?
Diversify.
Diversify, correct. And what's the most common thing people diversify into? Bonds, correct. There are some problems, though, with having a permanent allocation to bonds. First of all, there's the drag on performance that we can expect because of the lower return that bonds provide. And secondly, bonds are riskier than most people realize. Here's why people like bonds so much now. Because they have a negative correlation to one another. Stocks and bonds do. If stocks go up, bonds go down. If stocks go down, bonds go up. That's what we want. But that has not always been the case. If we look since 1927, stocks and bonds have actually been positively correlated more than they've been negatively correlated. The maximum drawdown of intermediate term bonds since 1900 has been 68%. The maximum drawdown of stocks, 73%. Not much difference. Since 1807, the worst rolling 10-year return was worse for bonds than for stocks. And bonds went through a long, long bear market from 1946 all the way to 1981. So what else can we do? Well, there are two types of momentum. There's relative momentum, which we've been talking about so far, where you compare performance to your peers. And there's absolute, or time series momentum, where you compare performance to yourself over time. And what do I mean by that? Taking the S&P 500 as an example. If the S&P 500 has been positive over the past year, if it's gone up, that means it has positive absolute momentum. And we invest in it and continue to stay in it. If the S&P 500 has gone down over the past year, it has negative absolute momentum, and we get out. Now, what do we do when we get out? Well, we saw earlier that stocks and bonds are negatively correlated. So, let's go into bonds then. Let's go into bonds when it makes the most sense, when everybody else is getting out of stock and putting their money into bonds. So that's what we do. The absolute momentum strategy is to switch between the S&P 500 and the Barclays U.S. Aggregate Bond Index. This is a low duration, high quality bond index that you can invest in. We do monthly rebalancing and again use the same one-year look back. Let's see how that's done. Here's your aggregate bond index. Here's the S&P 500 again. And here is absolute momentum. Now, we end up here in the same place that we ended up with relative momentum. But we have a much smoother ride in getting there. So if you have to choose between absolute and relative momentum, which would you choose?
Absolute.
Absolute. You make just as much money and you have a much more pleasant time getting there. However, there's no reason why you have to choose. You can invest in both. And that's my contribution to the world of finance. This is what I call dual momentum. We use relative strength momentum to switch between the S&P 500 and the rest of the world. And we use absolute momentum to switch between stocks and bonds with monthly rebalancing and a 12-month look back. The way this typically would work is we see if the S&P 500 has been up or down over the past 12 months. If it's been up, we compare it with the rest of the world. And we invest in whichever of those two is stronger. If the S&P 500 has gone down over the past 12 months, we move to the safety of aggregate bonds. Let's see how that is done. This is the most important table you'll see today. We'll start from the bottom and work up. Here's the return from the two stock indices we talked about. It's a little under 12% a year from 1971. Standard deviation, 15 to 17%. Maximum drawdown, a bit over 50%. When we move to relative momentum, there's our 3% a year increase in return. But our standard deviation remains in this area. so does our maximum drawdown. When we go to absolute momentum, we still get a nice increase in return, but look at our standard deviation. It drops to just 12%. And our worst drawdown drops below 30%. Now when we combine the two together into dual momentum, we get what I call my global equity momentum model. The average return is almost 18%. Our standard deviation is very low, similar to just using absolute momentum, and our worst drawdown drops to under 20%. There's some synergy going on here that makes the whole greater than the sum of the parts. We can see this graphically. Here's your S&P 500. Here's the all-world index. Here's absolute momentum. Here's relative momentum. We end up about the same place, with absolute being much smoother ride. And here is dual momentum in the form of our gem model. Looking beneath the surface a little, this is what happens in bull markets and bear markets. In the 6 bull markets since 1971, the S&P 500 has appreciated 278% on average in each of those bull markets. Absolute momentum by itself would have lagged behind because it gets whipsawed sometimes. It'll get in and out on false signals. But by combining relative momentum with it in our gem model, we earn a higher return in bull markets if you're patient. What's really interesting is what happens in bear markets. During the 5 bear markets, the S&P 500 has dropped 37%. Relative momentum didn't do much better than that. But by using dual momentum, where we get the benefits of absolute, we actually earned a profit when everyone else was losing money in bear markets. Now, why is this so important? Well, if you have a 50% drop, how large a return do you need to get back to even? 100%. That's right. Very good. Let's take a look at this a little differently. Here are 12-month rolling returns for the S&P 500. So every 12 months, we take a window going forward. And we look at the distribution in this histogram. We have a maximum on the downside of 45% and on the upside 65%. Now let's look at what happens with the gem model. The maximum on the downside is minus 20 and on the upside is plus 95. When we overlay the two together, we can see we've cut off the left tail of the distribution and we've extended the right tail. So here are the advantages we have with dual momentum. We have high scalability. We can trade as much as we want in these kind of indices. We have low volatility, which we all want. We have low frictional costs. There's only 1.3 trades per year using this approach. And we have a disciplined approach. We don't have to guess where the market's going. All we have to do is follow the rules. Are there risks associated with this? Of course. First risk is tracking error. In 1979-80 and 2009 through 11, we underperformed our benchmark. No investment is perfect, but it's important that we don't give up on it, because keep in mind what it did in the long run. Secondly, there are whipsaws and lags in bull markets, and you'll see buy and hold do better because of that. But we know that if we're patient, relative momentum will overcome that for us, and we'll be better off in the long run. And finally, short-term volatility is still high. We're not trying to time every little movement in the market. We're just trying to stay in tune with the major trend. Participate in bull markets and get out of the way in bear markets. And because of this, when there's short-term volatility, we're still subject to it. We should embrace that volatility, because volatility is what creates profit. What do we need for success? We need patience. This is a get-rich-slow program. Warren Buffett has said, The stock market is a device for transferring money from the inpatient to the patient. We need discipline. We need to stick with it once we adopt it, not get shaken out. And finally, we need understanding. Understanding will give us the patience and the discipline that we need. Now, I've only touched the surface here today. To acquire more understanding, you can go to my website, you can follow my blog, you can read the research papers, and you can get my book. There are only 2 books, one of them is mine, that have been able to maintain a 5-star rating on Amazon with over 100 reviews. My book has an easy and quick do-it-yourself instructions for implementing what you've seen here today. And I'd like to finish up by reading you a quote from Seth Klarman, one of the top hedge fund managers of all time. He's made over $22 billion for himself and his clients. He says, investors should keep in mind that the most important metric is not the returns achieved, but the returns weighted against the risks incurred. Ultimately, nothing should be more important than the ability to sleep soundly at night. Dual momentum will give you that ability. I'll be around afterwards to answer any questions you have and to autograph and sell you my book. For those who adopt momentum, may the force of momentum always be with you. Thank you very much.